Hey everyone, welcome back to Corporate Decoder. Today we're cracking open a filing that might just make you say, wait a minute, what does that even mean for regular folks? Let's just say there's a bit of a glow up happening, or maybe a scramble for something brighter. And if you like getting these kinds of straightforward, no fluff breakdowns of important company news, make sure you're subscribed. We also have a Discord channel where we chat about all this stuff, so check the description for that invite. Alright, let's dive into what's going on with Avalon GloboCare Corp. What we're looking at here is a Form 8K, which is basically a report for making important announcements that aren't on a regular schedule. Think of it as the company telling the world, pay attention, something new and significant has just happened. The big news dropped on July 21st of 2025. Now, Avalon GloboCare might not be a household name for everyone, but they are involved in the healthcare and biotech space, and this filing centers around a deal they made to raise money. This part just tells us they're following the rules, which is always a good sign in the corporate world, especially when it comes to reporting to the Securities and Exchange Commission, or the SEC. They are publicly traded, and their common stock, the regular shares you might buy, is listed on the Nasdaq Capital Market under the ticker symbol LBT. This is important because it means they have to play by certain rules and report their activities. So what's the material definitive agreement? That's just fancy talk for a really important contract. And what did they do? They made a deal to sell preferred stock. Here's the core of the story. Avalon GloboCare sold 300 shares of something called Series C Convertible Preferred stock to an investor called Mast Hill Fund. They got $300,000 for this, which works out to $1,000 per share. Now, what's preferred stock? Think of it as a special kind of stock. It often comes with certain rights or preferences over regular common stock, like getting paid dividends before common stock holders. And convertible means that down the road, this preferred stock might be able to be changed into regular common stock. They're not getting the full $300,000 in their pocket though. After all the fees and costs associated with making this deal happen, they're expecting to walk away with $290,000, so that's $10,000 that went to expenses. It's not a small chunk, but when you're raising hundreds of thousands, it's not unusual. This is a pretty key detail, even though this is convertible preferred stock. They can't just magically turn it into regular stock without getting the thumbs up from their own shareholders first. This is often a requirement when a company might issue a lot of new stock, as it can affect the value of existing shares by diluting ownership. So they've got a hurdle to clear before that conversion can happen. Now, this next part is really important for understanding how these shares were sold. They didn't register these shares with the SEC in the usual way, which is a process that can be pretty expensive and time consuming. They used an exemption, specifically Section 4L(2) of the Securities Act. This exemption is typically for private placements, meaning they didn't offer these shares to the general public, but rather to a select group of sophisticated investors like this Mast Hill Fund, who are considered accredited investors. It allows companies to raise capital more quickly without the lengthy registration process, but it means the shares might have some restrictions on them. And for anyone who really wants to dig deep, they've filed the actual agreement as an exhibit. This is the actual contract being referenced. It's like the blueprint for this $300,000 deal. And finally, whoever is in charge of making sure these reports are filed, in this case the Chief Financial Officer, has signed off, confirming that what's in the report is true and accurate to the best of their knowledge. The signing date is a couple of days after the actual deal, which is normal for processing and filing. Looking at this filing, what's the real story here? Avalon GloboCare needed cash, and they got it by selling a portion of ownership, albeit preferred ownership, to a private investor. This is a common way for companies, especially those in industries like biotech that can be capital intensive, to fund their operations or specific projects without taking on debt. The fact that they're using a private placement and relying on exemptions means they're likely trying to move fast. The crucial part for us as observers is that they need shareholder approval to convert this preferred stock into common stock, which suggests they're being mindful of not unfairly diluting the ownership of their existing shareholders. This could be a positive sign that they're trying to manage shareholder interests carefully, even as they seek funding. However, it also means there's an extra step and uncertainty before this funding fully translates into more common equity flexibility for the company. Now, what does this mean for Avalon GloboCare? Raising money is good, it keeps the lights on and can fund research or development, which is vital for a company in this sector. The valuation of $1,000 per share for preferred stock might seem high, but preferred stock terms can be complex and include various rights, so it's not a direct comparison to common stock pricing. The key risk here is always whether the company can use this cash effectively to grow and generate returns that justify the capital raised, and whether they can navigate the shareholder approval approval process smoothly. If they can, this $300,000 per share for preferred stock might seem high, but preferred stock terms can be complex and include various rights, so it's not a direct comparison to common stock pricing. The key risk here is always whether the company can use this cash effectively to grow and generate returns that justify the capital raised, and whether they can navigate the shareholder approval process smoothly. If they can, this $300,000 is a helpful boost. If not, it's just a temporary. What's your take on this financing deal? Does it signal a strong move for Avalon GloboCare, or are there underlying concerns you see? Drop your thoughts in the comments below. If you found this breakdown helpful, please give it a like and subscribe to Corporate Decoder for more insights. And remember, our Discord community is a great place to continue the conversation, so click that link in the description. Thanks for watching, and we'll see you in the next one.